Thanks a lot, Mike, for the introduction and for setting the scene of actually looking at equity strategies more broadly and the role that ETFs can play for market growth. My name is Martina Macpherson. I'm heading the Sustainability Indices at Dow Jones Sustainability Indices, or at Dow Jones Indices. Roughly a range of 150 sustainability indices that cover a broad spectrum of very dark green into more broadly holistic ESG and also smart beta indices, as Mike has just mentioned. I'm also a guest lecturer at Henley Business School and University of Zurich, covering sustainable and microfinance topics. So I'm actually in the moment traveling the world talking around the implications for sustainable finance, green finance, sustainable finance, and sustainable investing. And I just wanted to capture a few ideas of where we see current opportunities and trends here from an index perspective, but even beyond. So what I've done actually with the first slide here, I've done something which is not necessarily always seen as, the core part of ESG analyses. I've tried to pull up a slide that's here, the World Economic Forum, Zurich's report 2017, looking at global trends and risks. And it's very interesting and very telling that just yesterday the OECD launched a new report looking at how actually we can no longer look at modern portfolio management theory in the context of Markowitz, of thinking that we can capture and understand the full implications of actually extra financial criteria, as I would call them, in financial decision making, that we need to move beyond, that we need something that's going beyond tracking past performance and current status quo into forward-looking analyses. And this is exactly what this slide stands for here. I'm part of a working group with Willis Towers Watson, looking as well in a similar way at a broad range of different categories or pillars, looking at society, technology, economy, environment, and beyond, and how we can interconnect key issues and ultimately then build scenario analysis around this. And here you can see the big topic very often where we're starting the ESG debate, environmental challenges, very often quantified via, for instance, climate change analyses. Interestingly, most of the other elements here, looking at social implications, may they be wealth disparity, may they be increasing polarization or an increase in population. And it's by no means very interesting to see that, because it's now going forward from the environmental into the social issues that we need to capture more broadly, that we need to quantify and to be able to understand ultimately the broader impact of environmental challenges and how they ultimately impact investment decision making. So from that very high level debate, quickly into where do we see the key challenges? So one of the major challenges so far has been for investors to define taxonomies, terminology, metrics even, and of course overarching frameworks, very important actually for index construction as well, because there is a multitude of different type of taxonomies, even goals out there. As you can see, captured here, the different type of economic, social, and environmental applications, are they actually converging? Very often so not. We're seeing that here on the top left-hand corner. Different issues, key issues, not always well assessed and definitely not understood. And very often the starting point again is understanding the ecological footprint from an ESG perspective, less so the social footprint. This is just actually happening as we speak, that multiple organizations, think tanks, ESG research houses obviously involved as well, are trying to capture the social implications and are trying to actually track and benchmark and measure the impact. I've picked an interesting element here because we're coming to that a bit later on. It's the discussion around gender diversity and obviously minding the gender gap. Something very interesting has happened here. We have seen multiple indices that have been launched in this space by providers looking at the leadership role that women undertake in organizations and where there might be a disconnect. May that be gender distribution or participation at a very senior level. What we are increasingly seeing, and what this Economist Intelligent Unit Index is trying to do at a sovereign level, is looking at the participation, distribution, opportunity set for female employees across the organization. So the interconnectedness, and I'm coming to that in a second again, of actually gender issues with broader human capital management implications, but most importantly to understand where the disconnect is. And it doesn't necessarily start and end at leadership level. It goes across the organization. It's clearly aligned with ultimately gender pay, opportunity set, as I mentioned, but also other issues, such as health and well-being, such as actually human rights and labor rights implications, and the alignment with broader goals. And that brings me to what you can see on the far right-hand side. The alignment of broader goals with social issues is now happening through the alignment of broader goals in the context of public policy making, corporate reporting, as well as investor interest and investor alignment. And one of these frameworks that's used for aligning all these goals is actually the SDG Framework. The SDG Framework that I've mapped out over here is broken down a bit further. Before I've shown you the 17 goals versus the 8 Millennium Development Goals. I'm not sure if the audience here has already looked into this topic. It's very important to say that the Millennium Goals launched in 2000 were actually initially ESG goals for a framework that was mainly used for philanthropic efforts. There's the discussion, where does sustainable investing sit? Is it actually a convergence or an add-on from the initial SRI debate versus, the philanthropy and impact investing debate? Ultimately, it's sitting beyond that. We see a new paradigm shift where all these different strategies are converging. But most importantly here for the SDG framework, for the first time, the effort has been made no longer just to align key goals from a UN perspective, a public policy perspective, and then looking into how can you fund activities, maybe through high net worth individuals or public funding opportunities. It's actually a framework that's been discussed and implemented together with investors and used as a reporting standard going forward for corporate reporting. I'm coming to that in a second to show you where, again, there is a convergence of goals between these different type of stakeholders in the investment value chain. But most importantly, why I'm playing this up here is to show you that the 17 goals and ultimately 230 indicators that are used within the framework are very applicable to many of these discussions that we're having in quantifying green and sustainable finance. Just as an example here, it has a broad spectrum of actually environmental standards or goals that are also in line with the Paris Agreement from 2016 around risk mitigation, adaptation, resilience building, and climate finance. So clearly the call for climate action, as well as obviously for strategies around affordable and clean energy, for instance. It goes beyond that. It has an element of looking into other natural capital risks implications. You've seen them on the first slide, macro trends and themes, especially around water, clean water, for instance, and life below water. I've picked these two as the major environmental themes. But for the first time, this framework actually introduces a broad range of social issues. And at the forefront, and we're discussing this later today, clearly gender diversity, as we said, decent work and reduced inequalities, all clearly interlinked, all pointing towards building a more sustainable framework for society. And it's interesting, I'm picking also goal number 11 here, because we are in discussions with a client to build an index around sustainable and smart cities, seen as their own ecosystem, given that by 2050 it's estimated that 70% of the world's population will live in urban structures. That means we have challenges to tackle that go beyond the pure infrastructure, straightforward infrastructure play, that actually look into how we can create these infrastructure, real estate, transportation requirements on a much more smart and sustainable basis. And that means the means of technology, the means of different ways of utilizing environmental strategies and implement them, and the role ultimately that companies can play with this is at the heart of what we are trying to assess. And by the way, by no means is this all encompassing. It's estimated that you need 5 to 7 trillion over the next 12 to 15 years in order to implement the Sustainable Development Goals. And while this is a fantastic new concept, the public funding side, by the way, is still, or remains still a huge challenge. It's estimated that only $1 trillion for the implementation of the goals are currently publicly funded. Same time, where there's risk, there's opportunity. We see clear upside potential for actually private investors now stepping up in the same way in context they have done with green finance, and ultimately scaling up the efforts and building vehicles and tools that can help with the implementation. Quickly, last but not least, I've mentioned that I wanted to showcase how the different type of goals in the context of SDGs are beyond as well in the ESG or on the ESG side are finally converging. So we see, a clear trend from a public policy perspective, from a corporate perspective, as well as from an investor's perspective, towards looking at frameworks and looking at vehicles that encourage and actually support long-term value creation and decision-making. And you see on the far left-hand side, a couple of very high-level concepts and goals. I just wanted to showcase again how interlinked these are. So on the one hand, the Sustainable Development Goals and the vision for Agenda 2030 and then 2050, as well as a new agenda for business. And that's the agenda for business that's estimated that we need 5 to 7 trillion over the next 12 to 15 years. You see clearly the Paris Agreement, not in silo, actually fully aligned here, the need for climate finance as part of this roadmap. And then you see, interestingly, a couple of drivers and enablers for the ESG space. And that's predominantly regulation. We see a clear trend from voluntary codes, stewardship codes, corporate governance codes, into actually prescriptive regulation. And France is actually here at the forefront with the Energy Transition Law, Article 173. But the EU more widely as well is starting actually to provide directives like the 2014-95 directive, for instance, that's mandating ESG integration in the context of disclosure at a corporate level. So this is actually a directive that looks at disclosure of non-financial information and diversity, interestingly enough. And that means ultimately we will actually over time gain a better insight into company performance in the context of sustainability and beyond that will drive actually better metrics and ultimately will help us in aligning the goal of building more standardized frameworks, metrics, or frameworks, taxonomies and metrics, and ultimately investable tools. And side by side, interestingly, the corporates themselves, I don't know if you've watched this very closely, but there is an increasing interest in actually reporting in line with more standardized frameworks. May they be SASB, may they be traditionally GRI, Global Reporting Initiative, or the Integrated International Reporting Council, IRRC, or may they be even driven by what we see increasingly a listing requirement of global stock exchanges to ensure, that the relevant ESG mandates are set and met by corporations, and they are driving this themselves. There's been most recently actually an initiative that looks at TCFD, so that's the new task force for climate change disclosure that Michael Bloomberg has set up and that S&P Global also proactively supports. And there has been an initiative by a global CEO of some of the largest organizations worldwide right now that are actually mandating to implement the TCFD recommendations into obviously regional either legislation or at least into best practices of corporate strategy. And that's coming directly from the corporations, no longer just from the public policy makers. Last but not least, on the far right-hand side, the interest of investors. Quickly to mention, this market has grown significantly. So we have seen roughly now $23 trillion in sustainable investment strategies. We have seen the PRI, the Principles for Responsible Investment, one of the other key indicators, running from initially $4 trillion just 10 years ago into actually 60 trillion at the end of 2016. We are seeing actually that there is an alignment of investor interests and the mandate that's been clearly set towards driving ESG, integration, engagement, and ultimately the traditional structures around screening, exclusions, etc. And that there are enormous investor coalitions that have been built. For instance, here I've picked the Montreux Carbon Pledge, the Focusing Capital on the Long-Term initiatives that have multiple trillions behind them, where investors are actually setting the mandate for ESG. May they be on the disclosure side towards corporations, or may they be actually lobbying and engaging governments to mandate again legislation and bring down and actually define actually implementation. One thing that we have seen is still missing, and this is why we're obviously debating this today, is actually the relevant set of benchmarks. There have been a couple of benchmarks here, and I'm coming to this on my last slide, that are looking in capturing ESG momentum. We have seen broader indices, efforts by major index houses that look at the wider ESG connotations, maybe defining the best-in-class leaders in sustainability. We have been part of that debate, but actually capturing the momentum towards long-term value creation, towards SDG frameworks, and ultimately building impact. Looking at assessing the market towards opportunities, not just risk mitigation. is something that's up and coming. And again, on my trip from Tokyo to Hong Kong to LA, I've actually had the feedback from investors worldwide that this is actually a key prerequisite where we should no longer just actually stop the debate, where we should actually open it up and be an active, passive driver in bringing, opportunities to market. And with this, quickly, as I promised, the last slides here of showcasing 2 examples of where S&P over the last year has been significantly engaged in the market in building indices that go beyond, just tracking best-in-class sustainability. One is actually the long-term value creation index. It's been developed in collaboration with the CPPIB, one of the leading asset owners. And the other one is here, the JAPEX, S&P CAPEX and Human Capital Management Index, that tries to capture the correlation between company performance and productivity levels linked back to human capital management practices and CAPEX, and ultimately economic prosperity. So for me, this is actually both of these initiatives. The long-term value creation initiative tries to encourage constituents to actually showcase best-in-class performance towards governance implications as well as towards financial criteria over a minimum of 3 years, because we are holding the constituents proactively in that index, regardless of rebalancing. And the other index, as I said, is really trying to interlink the debate of where we are seeing currently challenges linked in particular to how companies not only are governed but run from a human capital management perspective, and how we ultimately need to make the links towards wider implications for business and society overall. And then last but not least is really my last slide here to quickly give you a bit of context. I mean, these are the different type of index strategies I've outlined at the beginning of my discussion, where we are trying now to move from innovation and seeing where we capture the essence of ESG in the market into building also a framework for headline indices that can capture the different shades of green of investors. So for instance, we have a variety of pure ESG indices, thematic indices, very relevant in the context as well of macro trends and themes, and impact increasingly so. We have core-like ESG indices. Again, they are actually looking more at delivering a financial and an extra financial return with a strong T&E component in it. And we have last but not least, the largest interest now that we are seeing in smart ESG or smart beta indices, where we are doing exactly what I just described very briefly in combining financial factors, criteria, with ESG criteria and trying to see where they actually correlate, converge, and where there might be room for more opportunity. And with this quick overview, I'm finishing today's talk and leading over to Rachel Alembakis to quickly introduce our panel. So for any type of questions, either please feel free to ask them now, or we can take them during the panel discussion. Thank you.